All right, let's talk about a real head-scratcher from OFG Bancorp's latest earnings. On the surface, everything looked pretty good, right? But the market's reaction was, well, absolutely brutal. So let's dive in and figure out exactly what happened here. So let's start with the good news. OFG came out and reported earnings per share that beat what Wall Street analysts were expecting by a solid 10%. I mean, in the earnings game, that's a pretty clean win. But then this happened. On the very same day, the stock just cratered, closing down more than 8%. So think about that. A 10% beat on earnings gets met with an 8% sell-off. This is the kind of thing that makes you go, wait, what? You know, on Wall Street, we call this a bad beat. It's when a company puts up these great-looking headline numbers, but the market looks right past them, digs into the details, and finds something it really doesn't like. So let's do exactly that. And look, you can see the headline story right here. The GAAP EPS was $1.27, which easily beat the street's estimate of about $1.16. Revenue also edged out expectations. So by all the usual measures, this should have been a good day. So if it wasn't the top-line numbers, what on earth caused that sell-off? Well, this is where we get into what analysts call the quality debate. We're going to unpack the three big concerns that totally overshadowed that earnings beat and sent investors running for the exits. So the crucial question is, what did the pros see that the headlines just completely missed? Turns out there were a few pretty significant red flags hiding in the fine print. Okay, problem number one, margin compression. A bank's net interest margin, or NIM, is basically its core profitability. It's the spread between the interest it makes from loans and what it has to pay out for deposits. An OFG's NIM is shrinking, which is a huge warning sign that their main business is becoming less profitable. Problem number two was an efficiency miss. The efficiency ratio tells you how much it costs a bank to make a single dollar of revenue. The lower the number, the better. OFG's ratio came in at 56.7%, which was worse than people were hoping for. It suggests their costs are running a little too hot. And finally, problem number three, and this one's a biggie, credit noise. The bank had to set aside more money to cover potential bad loans, and they also wrote off more loans than usual. For an investor, that immediately raises the question, is the quality of their loans getting worse? And you don't have to take my word for it. This quote from the analyst chatter after the call just sums it up perfectly. It says, investors blew right past the good headline number and focused entirely on those worries about profitability, costs, and credit. Those underlying trends were just way more important. So that's the bear case. That's why people were selling. But what about the company side of the story? Well, management is really trying to change the conversation to get people to see OFG not just as another bank, but as a digital leader in its home market of Puerto Rico. So here's their pitch. They're pushing hard on a digital-first approach. They're expanding into commercial loans, and they're really trying to position themselves as the innovator in Puerto Rican banking. They believe this is their real long-term advantage. And the CEO, Jose Rafael Fernandez, was not shy about it on the call. This quote just shows you how confident they are in their strategy. They really believe they're playing a different, longer game, even if the market is caught up in the short-term numbers. But you know how it is in investing? The past is interesting, but the future is what really matters. So the most important part of any of these calls is the forward guidance. Let's see what OFG management told investors to expect for the next year. And here we go. This slide right here is probably what sealed the stock's fate for the day. Management guided that their net interest margin would actually fall next year. This confirmed the market's biggest fear. That profitability squeeze, yeah, it's not over. It's going to continue. Next up, expenses. Management said costs would be roughly flat year over year. Now, that's not a disaster, but for investors already worried about efficiency, they were hoping to hear about some big cost-cutting plans. Flat just didn't cut it. And to round out the picture, the outlook for loan growth was pretty uninspiring, guided to the low single digits. So let's put it all together. Shrinking margins, flat costs, and slow growth. It's kind of the perfect recipe for investor anxiety. Okay, so we've seen the results, the market's reaction, and the guidance. That brings us to the next call, where we put it all together and give you our prediction, our rating, and a potential trade idea. All right, so here's our take. First, we expect that profit margin, the NIM, to hit the low end of that already weak guidance. Second, for the stock price, we think it could face more pressure until we see clear signs that their credit situation is stabilized. And for that reason, we're giving the stock a rating of market perform. So, given that whole outlook, What's the actionable idea? How might a professional look to play this kind of situation? Here's an outrageous but plausible idea for you: a pair trade. This means you'd go long or buy the broader regional bank sector, maybe through an ETF like KRE. At the exact same time, you short OFG. Now, the logic here isn't a bet that all banks are going to fail. It's a very specific bet that OFG is going to underperform its peers because of all the issues we just talked about. And that really leaves us with a big, lingering question. You've got management playing the long game, betting everything on this digital transformation. But you've got the market, which is obsessed with the short-term headwinds on margins and credit. Can their innovation story actually win out before investors just completely lose patience? That is the billion-dollar question for OFG right now. And as always, remember, this is not financial advice.